Hi everyone, thanks so much for joining us today for our Stratafin webinar. Today we'll be discussing the ins and outs of community scheme loans, and it is something that we see a lot of questions about, how to the compliant way to accept a loan, what happens with loans, that kind of thing. So we thought it would be a good time for us to discuss the ins and outs of the loans and community schemes. Just a little bit of info from our side. We are recording the session, so you will be able to access it after the webinar. I'll send out an email afterwards and you'll have access to it. It will also be on our YouTube channel, so you'll be able to view it there. So let me introduce our speakers today. So we've got Willie Roos, who's the CEO of Stratafin, and Willie has practiced as a property attorney for over 20 years. Involved in sectional title management for 8 years, or over 8 years, and Willie started Stratafin in 2014 with the goal of assisting bodies corporate with their funding without catching them in a debt trap. And today we've got Marissa Joubert, who's the financial director at Stratafin, and Marissa is a qualified chartered accountant and a current financial director at Stratafin. She obtained her BCom honors in accounting sciences from the University of Pretoria, and completed her articles with PwC, qualifying as a CA in 2014. She spent 5 years within the financial services division in Imperial, which is now Motus, working with special purpose entities and cell captive structures, and joined Stratafin in 2020. So I've told you a little bit about us. We'd like to hear who you are. So I'm going to set out a poll for you all. If you can just answer that. Who are you? Owner, trustee, managing agent, other. This is a multiple answer, so you can choose more than one.
So if you are a trustee and a managing agent, or an owner and a managing agent, or an owner and a trustee, then you can answer other, so that we can have an idea. Looks as if most of the participants are managing agents, but there's also a huge amount of owners and trustees that are here. So together they actually are the largest percentage of participants.
I'll leave it on the screen for a couple more minutes and then we can get going. Please, if we're going through the presentation and you want to ask some questions, please feel free to put it in the chat or the Q&A, and as we're going through, we can answer those questions for you. Alternatively, when we get to the end, we can answer those. Okay, great. Well, thanks so much, everyone, for answering that. And here you can see the answers. So it's great to see everyone here trying to learn more about loans and sectional title. So I'm going to hand over to Willie, who's going to take us through this.
Morning, guys. All right, so in terms of section 4 of the Sectional Title Schemes Management Act, a body corporate is entitled to borrow money in the exercising of its powers and to perform its functions. You can, as a body corporate, you can secure that lending by way of a notarial bond over your property, so any property that is owned by the body corporate, or alternatively by ceding your levies, future or past, in respect of the monies borrowed. So in general, we see in practice that levies are ceded. There can be an outright cession or a cession in securitatum debiti, which means that the levies still remain the levies of the body corporate, but only if the payment is not made to the lender, then the lender can proceed to try and recover from the levies the amounts owing to them. A body corporate is also required, in terms of the law, to indicate where they have borrowed money on their financial statements. So as a prospective buyer, or owners and trustees, you need to ensure that once the body corporate has borrowed money, that is reflected in the financial statements of the body corporate, which is then presented to owners on a yearly basis. That statement will also indicate what is owing, so that when somebody has a look at the financial statements, they can see that money was borrowed and what is currently outstanding and payable, and the period that loan has to be repaid on out of the financials. All right, so let's deal with the compliant way to accept loans. So the Sectional Title Schemes Management Act and the rules require that an authority to obtain a loan must be authorized by a special resolution of owners. That means that a 30-day notice period in terms of Section 6.2 of the Act needs to be given to all owners, and it also need to include the wording of that resolution that needs to be taken, that needs to be sent out to owners, for owners then to consider. With a special resolution, you require a normal quorum of 33% of the owners, and then you need 75% of the members in value and in numbers, so by way of the amount of, by way of your participation quota as well as your vote for your section. It is determined then that the vote that was tabled was then accepted. You need to ensure that you've got voting cards in respect of this. All owners are entitled to vote in respect of special and unanimous resolutions. So where you have owners that are in arrears and judgments have been obtained, they are still entitled to vote in respect of these special resolutions. So everybody is entitled to vote in respect of that. So it's important that that is followed and that those people are not excluded, because that can invalidate the decision that was taken. You can also, by way of round robin, make that decision, but then you require 75% of owners to actually vote by way of round robin. So the percentage move up from 33% and then 75% of that 33% to 75% of owners. So it's a far more onerous way of obtaining the authority. So we suggest in general that you rather call a meeting and have a meeting rather than go the round robin way. Then we have on our website, we've done free resources in respect of special resolutions. We've got the voting calculator that can be utilized to determine the amount of votes. That's also there. So you just pick the amount of, or the resolution that you need to make, and the calculator will then tell you what is required in that regard. So you guys can have a look on the website under free resources, and those things are available there to assist as far as possible to make sure that your votes are compliant.
And it also tells you if you've got quorum, and then whether that you've got enough votes on your from your quorum. So it's quite a handy
little calculator. But I mean, some people have found it difficult. So if you have a difficulty with using it, you are more than welcome to contact us. And Marissa is the author of the calculator.
It's a complex voting process. So the calculator is simple to use, but the process of voting is still complex. So if you need some assistance, you're welcome to reach out.
And I will also, in the email, sorry, Marissa, in the email that I'll be sending out after the webinar, I'll also include the links to both of those free resources. Perfect.
You wanted to say?
I see we have a question that relates to the previous slide. Clive's asked he'd be most interested in knowing about required security and the impact that would have on clearance certificates in the body corporate. So Willie, I don't know if you can speak to that.
I don't understand really how that can have an impact on clearance certificates. So maybe Clive can explain the question a bit better, because at the end of the day, if a body corporate has budgeted to take a loan and that is included in the levies, and somebody is paying levies, then obviously it will not have an effect, because it will be payable in accordance with the levies, and the levy clearance will be up to a certain date, and those levies will then be paid by that owner. If it was by a special, if it was a special levy, so you have obtained a special levy to make sure that the loan is paid, then obviously it will have an effect on the clearance in as far as the new owner, from the date that he becomes the new owner, will be liable for that portion of the special, or the unpaid portion of the special levies from that moment on forward until that special levy is paid. It's the only way that I can think that it has an impact on that. But maybe Clive can explain a bit better, and then I can try and answer.
Clive, I'm going to allow you to talk. You're welcome to explain your thinking.
Good morning, all. Thank you for the opportunity. I've not had personal experience where any of our BCs have required this type of finance, but I can understand the need. I do seem to think somewhere many years ago that the lender in some way wanted to take cession of future clearances, or have the right to sort of have an impact on that. Perhaps I've got it wrong, but thank you for the opportunity.
Sure. Clive, I think all the lenders in the industry does contractually agree with the body corporate to be involved in the issuing of the clearance certificate, because of the fact that the levies is held as the security. One wants to ensure that you do get payment when the clearance certificate is issued in respect of units that have arrear levies, or future, where future levies was taken, then to ensure that the future levies that have been raised after the money was lent is then paid, and the financial institution gets paid for that. So that is a norm that is being used, or it is a mechanism that is used by all the financial services providers in the industry that give this type of finance, because that is the security. Okay.
Perfect. Let's continue.
Okay, then something that's close to my heart. It's also in my bio. I say that.
Sorry, can I interrupt you? We have Andrew has commented something regarding the train of thought we were just on. He asked about the seeding of the levy debt. Is that by a trustee resolution or an owner's special resolution, especially if the BC has separately allowed the BCS necessary to borrow money required by it in its performance of its functions? So whether I'm reading this question as, is the session done by a trustee's resolution or an owner's special resolution?
So our take on it is that it is authorized by a special resolution of the owners when that money is lent, and the whole terms of that agreement is placed in front of the owners. At the end of the day, it is the trustees that actually sign the session, and that then ensure that that session is being complied with. But the borrowing of the money and the security surrounding it, we deal as one matter, and include that in one resolution taken by the owners at a special general meeting. There has not been case law, as far as we are aware, which actually clarifies if the session itself can be separated from the loan, and if that can be a decision only to be made by the trustees. So therefore the loan is placed in front of the owners, but not the mechanism of security. So we have never seen case law in that regard. So it will be interesting. I mean, I can think that one can make the argument to the other side as well, that it is merely a trustee's decision what security can be afforded. But yeah, so until such a time as we've seen courts make a decision on that, we would not, I mean, it's speculation. I mean, my opinion is my opinion, and somebody else might have a different opinion in that regard. So to come back to what is a debt trap? What is a debt trap? So it's something that's very close to my heart, and I think that it is something that all schemes need to try and avoid. It is a mechanism by which the lender ensures that the borrowers remain indebted to the lender, and whereby they obtain payment without an end date or without an end total to be paid. So there are various products in the market that, according to us, are debt trap type of products. Not that we are saying that they are not useful for bodies corporate, but it is something that a body corporate must make sure that they avoid if possible, because at the end of the day, interest is being paid to a lender for an undisclosed period, and that keeps on being paid by the compliant owners until the loan is paid or the debt that was ceded has been recovered, and that can take years. So we've seen schemes that have borrowed 300,000, repaid in interest 600,000-700,000, and still owes 300,000 rand to the lender. And that type of loan is a very dangerous loan for a body corporate, and at the end of the day can have the effect that body corporate become dysfunctional, because all the money that is supposed to be used in respect of the task that must be fulfilled by the body corporate goes to the lender instead of looking after the properties of owners. It can also happen where the body corporate takes out the loan and they can't afford to pay the minimum payment in respect of interest and capital, and they will just keep on paying interest and never reach the end date of the payment. So that is very, very dangerous. What we have seen through Confiance Administrative Solutions, where we administer properties in terms of Section 16, is that where this has happened, your compliant owners eventually also get to the point where they no longer pay levies anymore, because they feel that all the money is being utilized in respect of interest payments, and at the end of the day they also stop being compliant, and the scheme then eventually collapses. So one must be very, very careful when one deals with these type of loans to remain out of a debt trap. Okay, how to avoid falling into a debt trap? Okay, so you need to ensure that you've got sufficient money to cover your monthly running costs. Don't ever utilize monies borrowed in respect of running costs. That is a terrible situation that you find yourself in, and it clearly indicates that your budget is not sufficient and you've not budgeted properly in respect of your monthly running costs. A problem that we pick up that happens a lot in this regard is where a body corporate determines the amount that it's going to need for the running cost of the scheme for that specific year, but does not take into consideration that all that money is not paid by owners at the right time. So therefore it creates a cash flow problem. The levy debt sits there, but unfortunately it's not cash, and can't be utilized, and then requires a credit card in inverted commas to actually pay for those expenses. And we all understand that if we start spending our credit cards at Willie's to pay for food, we're running ourselves into a problem, and we need to sort that out. And the same principle applies for your scheme as well. You'd never want to get to that point where you utilize a loan to pay monthly running costs. At that stage, the trustees need to look, and the managing agent need to look at the budget and ensure that there's sufficient budget to cover those things, which then includes a provision for the non-payment. So that needs to be put into your budget. You need to make sure that you provide for those payments that are not going to be made on time, and that there's sufficient money in that respect. Obviously, also make sure that you've got a proper maintenance reserve in place. Again, this is all about budgeting. You need to make sure that the money that's going to be spent over the next 10 years is budgeted for, and that you do have sufficient money to, when those expenses arise, to cover the payment thereof. In this instance, a loan can be utilized in respect of budgeted items that are in the future, but where the money becomes necessary at that moment, because you are going to recover that over the period of your maintenance reserve plan, out of your levy in that respect, and it can be paid over the remainder of the portion of the levy that is going to be utilized for that. Ensure then that there is a start and an end date to this loan, and that there is an agreed interest rate, and that you know what that is, and that you know what you're going to pay, because then you will avoid falling into a debt trap. Make sure that there is in your administrative budget also a bit of a reserve to make sure again that there is sufficient cash flow during the months where there is not compliance for that specific month. So it's always good to have a bit of cash, to be cash positive, and make sure that you can pay your expenses. Budget for your cash flow shortfalls due to non-payment of levies. Important, as I said. One thing that we also note that does not happen frequently, and I think this stems from the previous act, where all legal costs were debited against owners. We now understand that in terms of prescribed management rule 25, you can't do so until such a time as the bill has been taxed, and it must be reasonable. And the difference between your taxed bill and your attorney and client bill will fall in your in your administrative budget, and will be paid out of the administrative budget. So therefore you need to budget for collections, because very few attorneys will work on a party and party scale. That is the scale that you will normally be able to recover from debtors. We have recently seen in some court matters that the courts are slowly but surely now granting again attorney and client orders, but you will have to make the right averments in your summons to get a court to actually grant those orders. But in general, courts grant party and party orders, which means that a certain portion of the legal fees will have to be paid out of the administrative budget. So if you haven't got a budget for that, again, going to create a cash shortage, and to then fund that out of a loan is not a good idea unless you've got a specific period and a specific payment and a specific interest rate that is payable, so that you know when it starts and you know when it ends and you know it has been paid. It's also important to take into consideration the in duplo rule. So there are two different in duplo rules. I think we are discussing it a bit later on, so I'll go into that a bit later on. But make sure that you understand what the double rule is and how it works. And also, if you have borrowed money and you have ceded your levies in respect of the outstanding levies to the lender, and there's an obligation on them to collect, agree on the collection periods and interest rates applicable during those periods, and what happens if it doesn't take place within that period. We have seen too many matters where bodies corporate have ceded their debt, and then those debts are not collected, and those debts are supposed to pay the capital amount, and they don't get collected for 5-10 years. And in the interim, the compliant owners just keep on paying interest on interest on interest, exceeding the in-due that debt will never be collected, because there's no incentive to actually collect the debtors, because as long as the debtors are not collected, then interest is being paid. So that it creates a problem for the scheme. So make sure that you have an agreement in place in respect of collection and collection periods, and some sort of guarantee and some sort of stop when this ends, and that the body corporate is not in a situation that they will keep on paying interest ad infinitum. Who deals with this?
Marissa.
Marissa, will you deal with us on affordability?
Yes. So in terms of the debt trap, the other way that you can accidentally end up in a debt trap is where you enter into a loan agreement and you can't actually afford to pay back interest and capital on a monthly basis. So looking at your affordability before you enter into a loan agreement and taking into account all of the various factors is very important at the beginning. So the National Credit Act defines reckless lending as when a creditor fails to do an affordability assessment prior to extending credit. However, business-to-business loans and loans above the value of 250,000 Rand do not fall under the National Credit Act. So for the lender, there's no recourse as to say that, oh, this
The borrower,
for the borrower, yeah. So there's no recourse to say that, oh, when we lent this money, when we borrowed this money, when we went into this loan agreement, this credit provider didn't check that we could afford it, and therefore this was recklessly lent to us, and therefore the loan shouldn't have come into existence. So your only recourse is to make sure that you don't go into an unaffordable loan. So the basic.
Sorry, Marissa, I think what is also important to understand, and we say business-to-business loans, and because of the fact that a body corporate is a legal entity and it is not a private person, it is seen under the Credit Act as a business.
Yes.
And that is where the problem or the conundrum lies, because even though we are dealing with individuals here in respect of their individual properties, under the law, it is seen as a business that is dealing with a lender that is also a business, and as such, the National Credit Act is not generally applicable. And that causes different problems. One of those is also the induplo, which we will discuss. And then also the other thing, like you said, is the loans are exceeding in general 250,000 Rand, and then they don't fall under the Credit Act as well.
Yes. So that means that you don't get the protections that the Credit Act offers for individuals in general. The other bit of a sneaky one is revolving loans that can also put you in a debt trap situation where you pay the loan and then can utilize the facility again. That's a place where you have to be very careful to make sure that you don't end up just having to pay every single month and not utilizing it in the most efficient way. So the main things to look at when you are assessing the affordability, which will then be something that the body corporate has to do before entering into a loan agreement, as the credit provider doesn't have the legal responsibility to do so. We need to look at your ability and willingness to repay the loan. So looking at whether your body corporate is functional. Are you compliant with the acts, and do you have financial statements for your prior years so that you can have a look and make sure that the body corporate is financially stable going forward. Any qualifications on audit opinions, looking at what was that qualification, why were the auditors not happy with the financial statements, and with the support available for the information that was then presented on the financial statements, because that could show you that there's some dysfunction within the administration of the body corporate. Prior cession of rights, so you have to make sure that there aren't any pre-existing loans that would make it quite onerous on the owners to be able to make those additional payments should they be necessary. Your monthly levy income, so if you have, let's use an example of, let's say you have a small body corporate, your monthly levy income is 20,000 Rand a month, and you need to enter into a loan agreement for 300,000 Rand. Over a 2 or 3 year period, you're going to look at a repayment per month of between 10 and 15,000 Rand. If you don't have so you technically already don't have the cash flow for that, because you only have levy income of 20,000 Rand coming in. So are your owners going to be able to contribute on a monthly basis for the next 3 years, every single month without defaults, the additional levies that you will have to raise to be able to pay off that loan and to make those monthly payments? The important part is not just to look at the willingness or the need for that capital amount right now to keep the scheme going, but to look at the ability of the owners, look at the economic circumstances where your owners are currently in, to make sure that they are actually able to contribute that, so that the body corporate doesn't end up in a default position because one or two of the owners are in a sticky financial position. That also links into the budget point in terms of making, if you need to raise an additional levy to pay off that monthly loan repayment amount, you need to make provision for the possibility that one or two owners might default on their levies at some point in time. So raise potentially a slightly higher levy so that you have the cash flow available, even if someone is in trying financial circumstances, that you can give them a month to get back on their feet and then still be able to make your monthly loan installment. You have to look at what your arrears levies are that you currently have on book, because that gives you information as to what your current cash flow is. It also gives you information as to what the payment pattern is that owners have. So it doesn't help to live in a unicorns and rainbows world of saying, oh, if we get all of our levies every month, we'll be able to make these repayments. But historically, you see that you have 20% of owners who pay 2 or 3 months late. They might make a bulk payment every 2 or 3 months, but that is going to affect your cash flow. And the cash flow is very important, because the cash flow is what determines whether your credit provider receives their payments on time and whether you are in default. Then looking at so we've discussed the value of the loan and the monthly repayment and the term, so whether double levy would be affordable. Then looking at the reason why you're borrowing money. It's as much as in your personal capacity, it's important when you take out a credit card for your body corporate. It's also important whether you are borrowing or enter into a loan agreement in order to pay monthly expenses, which might be pointing out a different problem in terms of budgeting and making sure that your levy income is sufficient to cover all of the running expenses of the body corporate. Whether it is something that has to do with your maintenance plan, which could be something like painting or waterproofing of the roofs that has all of a sudden become necessary due to a heavier rainy season. So you anticipate it'll be in 3 years and it's now all of a sudden necessary right now. So then you have that cash flow available in future periods as the maintenance reserve comes in. And then you might just have to go and look at your planning for your maintenance, your 10-year maintenance plan, and see how this impacts you in the future. So, okay, now we need to revise our estimates for when the next painting or waterproofing round will happen. And then whether the money you're spending and that you are borrowing will have a positive impact on your scheme asset value. if you are borrowing money and it's not going to positively impact the scheme, then maybe there should be a different approach to making sure those expenses are covered. It's going to maintain the scheme, if it's going to have if it's going to safeguard the market value of the units and the owner's value in their units, then it is a potentially good idea to enter into that loan agreement. And then finally, you always want to look at the securities that you have available. Should there be a default on the loan, what will, what protection does the credit provider have that if there's a default, they will still get their money back? And what impact does that have on the scheme should that occur? The value of the property, whether the value of the property is sufficient to cover the loan. You don't want to have a scheme that is in total, a very small scheme in total with 2 million and you take out a loan of 10 million rand. That you have insurance in place should there be some unforeseen natural disaster like we've seen in Durban, that your owners are safeguarded and that they will be able to restore their asset to the value it was and not have to sit with a loan amount that they now have to sort out in their personal capacity without any underlying asset value. And then whether there's a special levy that you can raise in order to get to that monthly installment amount, whether it's necessary, whether it's possible, whether that's affordable for the owners. And then I see we had a question that sort of links into this where Dolene asks, I suppose only owners participating in the loan will pay back levies, as some owners might pay cash for the improvements or maintenance. So the answer to that is no. The special levy gets raised across the whole body corporate. Yeah.
Or it's a loan by the scheme. So the point is that there are some loans where it's specifically apportioned to owners, but that is not a loan by the scheme. Those are loans by owners in their personal capacity, and it's not the type of loans that we are currently discussing here. I just want to say in respect of how one would assess your affordability in terms of the National Credit Act. The stuff that you have discussed now, so the 3 steps that is normally taken in respect of this, one would expect that if a loan from a lender to the scheme would fall under the National Credit Act, that would be the criteria that is being used to determine if a scheme can afford to repay that levies or can borrow the money. If they do not comply with the criteria, then a loan would not be granted. And if it is granted, it would have been seen as reckless lending under the National Credit Act. And we know that the National Credit Act is very onerous and would then prohibit the lender from actually recovering that money from the debtor. So a debtor will then...
Should the debtor default?
Correct. So the debtor would then not repay that, and they would have a defense in law that the money was lent to them in a reckless fashion. So in general, we said that this is not applicable in schemes. However,
yeah, it's not legally required.
It's not a legal requirement. However, there are lenders out there, and I can say without a doubt that Stratafin is one of those. We apply this criteria. We will not lend money to a scheme if we are not sure that the scheme does not comply with this, and we place ourselves under the National Credit Act, even if the loan does not fall and is excluded under the National Credit Act. We are a registered provider in terms of the National Credit Act, and we say we will always apply these criteria. So I think that it's also important that one needs to look at that, because you do not want to lend money to a scheme where you know that they will not be able to afford it, or where you will know that you will catch them in a trap where they will continuously keep on paying to the lender. And to the detriment of the scheme in general and to the detriment of the owners. I'm just waving. We're sitting here in Cape Town waiting for TVDM to start there. in-person webinar, and they're walking past us just here in front. So we're going to go there now and continue with another webinar or another event. But
the first physical event that we've been to in a while.
Yeah. But in any event, so that is what we are saying we would do, and we suggest that one looks at those type of things. I know that there are other providers in the industry that apply this as well. So we also believe that that is an amendment that needs to be made to the Act to protect owners in general against unscrupulous loans being made in the industry by certain providers. But I would think that in general, that is the smaller amount of providers that are not acting in a what is the word that I'm looking for, in a professional or a responsible fashion.
Willie, we then have a question from Andrew asking, what is the risk to individual owners if their body corporate defaults on the loan?
So the risk is that all owners are liable in respect of our law, in respect of jointly and severally, in respect of monies owed by a body corporate in as far as they have not paid their levies. So there is a risk to individual owners in this regard, and obviously one needs to ensure that the scheme does comply. We have seen many schemes that have come to the point where they couldn't comply, and where that scheme actually is then placed under administration in terms of Section 16 prior to one proceeding against owners and actually selling owners' properties in execution. But we have also seen many schemes where owners have not complied, where the scheme has gone under administration, and where those levies that have then been levied against owners to ensure that there can be compliance with the loans are not paid, and where owners have lost their properties, and those properties are eventually sold in execution through the courts. So it is a very risky thing for owners and for a scheme, and schemes need to ensure that money is borrowed in a fashion that does not place unnecessarily risk on owners, but assist, like you said earlier on, with the scheme's maintenance and so forth, and where it does add value to the scheme and doesn't only detract from the value of the scheme and from units.
Andrew then follows up and he says, to confirm then, as stated, it is only the owners who haven't paid their levies who would then be jointly and separately liable.
Correct.
Yeah.
Correct. However, the problem still remains that if the amount is not recovered, then there will still be action against the body corporate. So at the end of the day, owners will pay. I mean, money borrowed will result in money being paid. So it is a problem. So one needs to sort it out, and one needs to make sure that you do it in a fashion that it can be paid.
Yeah, that it's affordable, that the body corporate can afford it.
Correct. Okay, right. So where do we see debt traps and community schemes? Right, where you contractually agree with the lender to collect your levies. We see that in the industry a lot. So the lender actually takes the responsibility to recover the arrear levies, and that the recovered levies will then become payment of the capital amount. And whilst this happens, that the compliant owners pay interest. So this is a classic debt trap scenario, because the body corporate is not in control of the collection of their levies, and it is done by somebody outside on instructions of the lender. And if this takes an undue long period, then whilst this is happening, the scheme keeps on paying interest. We have seen schemes that have paid interest, I mean, that we have analyzed in our business, that have paid interest over 10, 12 years, and have repaid capital 4 or 5 times. So that is a huge problem. So that is a red flag. Have a look at that. Make sure that you do not have an agreement in place where the compliant owners or the scheme pays interest until such a time as those levies are collected. As I said earlier on, you need to have a cutoff in place. There need to be a guaranteed period for collection and so forth. And it has to have an effect on the collector as well. The scheme can't take that risk the whole time and have no recourse if it's not recovered. Where the amount borrowed is more than 250,000 and falls outside of the National Credit Act, that's also a red flag. So if your scheme requires 10,000 Rand or 20,000 Rand and you are given a facility of 251,000 Rand, be aware there's a reason why you are getting 251,000 facility and you can only utilize 50 or 30 or whatever. It is to place the loan outside the auspices of the National Credit Act. So be aware of that. If you want to take the loan, fine and well, great, but do so with your eyes open and understand why this is happening and why that facility is being granted to you. Where there's no agreement in place, that the interest is limited to the double or the in duplo rule. So we've got two in duplo rules in our law. We've got the common law in duplo, and then we have the National Credit Act in duplo. The common law in duplo differs from the National Credit Act in duplo in as far as the National Credit Act in duplo states that the interest and the fees for collection of the money, so your legal fees against you to recover the money borrowed, can just go up to the double. That's it. So if you borrowed 100,000, then the lender can only recover 200,000. That's the maximum. Even if you pay it on a monthly basis, you will only be able to pay, or you will only pay 200,000, and any payment thereafter will be deducted from the capital amount or the capital plus interest from the 200,000, and you will repay 200,000. So that's why it's important. If the loan can be under the Credit Act, then you are safeguarded in that respect. In respect of the common law in duplo, so that is the in duplo rule where it does not fall under the National Credit Act. Any payment, your debt runs up, so debt and interest runs up to 200,000. Legal fees can also be the legal fees is separate. It does not limit or does not fall in the limit of the double, and that can again run double. So if the legal fees were 50,000, then that can again run up to 100,000. So your 100,000 can become 300,000 Rand that you pay. If you then pay 10,000 Rand, then that 10,000 Rand is deducted from the 300,000, but the interest can now again run up to the double of 300,000. So if you don't make sufficient payments, then every little payment in respect of interest just reduces the interest, and the interest goes back, and it reduces the interest and the interest goes back. So at the end of the day, you will be caught in a situation where you will pay interest ad infinitum. So that's why it's important to understand the difference between the two, and why it is important to try and fall under the National Credit Act and make sure that you have the protection of the Act. Right, where the lender does not adequately assess the affordability by the scheme in respect of the amount borrowed and the monthly payments. So that's where you can fall under that, but like Marissa says, that obligation is actually now on you as a scheme in general, where it does not fall under the Credit Act, and you must make sure that you will be able to afford, because there is a problem in the sense that trustees has a fiduciary duty to act in the best interest of schemes, and where they have not considered this, there's no case law to this effect, but the fact of the matter is that if they haven't considered this and they haven't considered the consequences of this, it can have an effect on them. right, where the levies collected constitute a part payment of the initial amount borrowed, and the scheme then borrows monthly on a monthly basis for running costs. So this is a revolving credit situation. That always creates a problem. So where you borrow 300,000 Rand, you've got levy income of 200,000, your 300 is reduced by the levies. So it now becomes 100,000 owing, and then you borrow the next month again the 200,000 to go back up to the 300. Terrible idea. You are using credit to pay your running costs, so you are buying food from Willie's with your credit card. Terrible idea. Schemes should never get themselves in that situation. They need to make sure that they get themselves out of that as soon as possible.
Okay.
Right.
Yeah. So then the question becomes, how do you get yourself out of that?
Yeah.
So
Okay.
there are a few things you can do to start clawing back from that type of a situation. The first one would be to assess your arrear levy book and put processes in place to collect your arrear levies as soon as possible, and then processes for your current and future levy collections that make sure they don't fall into arrears again. You can look at engaging with a credit provider that would be willing to give you a fixed term loan to buy you out of the debt trap loan. Your whole affordability assessment will still be necessary there, because otherwise you run the risk of defaulting on your loan if you can't actually afford the fixed term loan monthly repayments. But if you can afford it, that is one way to start moving away from a debt trap situation. You could outright sell your debtors book, which is also a possible way to utilize the arrears that you have to make a dent in that debt trap loan that you are stuck in. And you can look at budgeting cleverly, seeing how you can make provision for additional levies that you can utilize to pay off capital on the debt trap loan, whilst you are still making the normal monthly interest repayments, because as you repay the capital, the interest will decrease and you will get to a position where you eventually pay it off.
Sure. So there's an obligation on trustees to actually go and have a look and see what they can do to get out of these type of situations. Because one wants to see that a body corporate utilize their funding to look after the scheme in general, and
Yes.
not just to pay interest. So trustees need to go and explore ways and alternatives to get out of this, and to where the funding of the body corporate can then be utilized for the benefit of the body corporate, and to ensure that the values of the properties remain proper and actually grows, and the scheme actually becomes a desirable scheme where people want to purchase.
Yes. Yeah, so with getting out of the debt trap, you're going to have to do some analysis to look at, oh, these are all the options that we have. This is the overall impact of each, and which one is going to be most beneficial to the scheme. I see we have a question from Deline again. She's just asking, am I correct in understanding that even if an owner can afford the additional cost, if the BC enters into a loan agreement, the owner will be part of the loan and loan repayments for the scheme for the entirety of the loan? Or can the owner pay the BC once off for his or her part and therefore not pay additional interest over the loan period?
You are part of a scheme and you form part of the scheme's budget. And if that falls within the scheme's budget to pay that, that loan and interest over the period of time, and it's budgeted for over a 3-year period and so forth, then you are liable in terms of your participation quota in respect of the expenses of the scheme. So that's unfortunately just how sectional title works. If that does not work for you, then obviously you need to look at buying a freestanding property where you can utilize your money the way that you require to be utilized. So it is what it is. I mean, if you're part of a scheme, part of the budget, you're in there. The Act does make provision where levies are paid in advance that trustees can give a maximum discount of 10% on that levies paid in advance. So one can actually go and, as an owner, probably go and discuss this with your trustees and say, I want to pay my levies in advance for the next 2 years or 3 years so that I can pay that portion and then get your discount in that respect. But you are part of a scheme and you're part of that budget. So that is the situation. Okay. Just quickly about the Stratafin model. Sorry, Marissa.
That's fine.
I see we're running out of time, so I just wanted to just get to the Stratafin model as well. So the Stratafin model, the body corporate outsources its risks for time and cost of the collection. So it is a situation where you do not, if Stratafin does not collect your outstanding levies within the period that is anticipated for that, then that risk is not falling on the compliant owners. They are not going to pay additional interest. They're not going to pay additional amounts. So in that sense, our model is different in the sense that we actually determine beforehand what period we think the collection will take place, and we take the risk and the cost of that if that doesn't happen. So we also then purchase the outstanding levy book, which give you immediate access to cash. There's no monthly repayments in respect of our debt purchase product. We do also do fixed term loans. Those are absolutely fixed term, so they are for a period of 2 years or 3 years, which is determined in accordance with the principles that Marissa outlined, and where we then make sure that the body corporate can afford that. If the body corporate can't afford it and they institute a special levy to actually try and bolster the levy book, we will check the compliance with that for a number of months before we actually do a loan, to ensure that the body corporate is not going to get to a position where they borrow money and they then at the end can't pay it because owners are not compliant with that. So we also through Confiance can assist with overdue and incorrect billed municipal accounts. So we see a lot of loans are being made where bodies corporate owe huge amounts to the municipality. We actually assessed one yesterday where a body corporate, after 2 years and 11 months, were just prior to prescription, they were billed 2.6 million rand because it was merely estimates that were run against the scheme for 2 years and 11 months. And suddenly they were billed for an amount of 2.6 million rand by the council. And in that instance, they then require funding, otherwise the whole scheme is going to be disconnected, and they approached us to assist in that regard. So what we do through Confiance is we will then run that through our model and ensure that the council has billed correctly, but we will also engage the council to try and come to an arrangement. And if there are periods that have prescribed in respect of the debt or the electricity charges and other charges, we will then deal with them and do it in a compliant fashion, make sure that it's done in a legal fashion as well. And it's done on a costing per hour basis. It is not done as a percentage of the amounts, because we also see a lot of people dealing with this as a percentage, anything between 10 and 25% per month, and per transaction. So depending what they get written back or written off, they then charge between 10 and 25%. And that gives an incentive for somebody to pay somebody at the council to write this off, and then it just comes back onto your account 6 months or 12 months later, it just comes back again. So we do it in a compliant fashion. We get the necessary paperwork in place and make sure that it's done properly, and Stratafin will then be able to assist with funding in that regard to make those payments to the council and make the arrangements in respect of your AOD or what arrangement you have in place with the council as well. So that's a bit about Stratafin and a bit about loans and debt traps. So I hope that we have been able to give you guys a bit of an insight of what we are dealing with and what we see in the industry, and what we try and do make sure that the industry is compliant and owners are treated fairly and equitable in the industry.
I think just before we jump off here, there's one last question here from Andrew. As mentioned earlier by Marissa in her presentation, what is the view of Stratafin as to the circumstances by which a BC is allowed to write off arrear levies? Arrear levy debt if levies have been legally raised by trustee resolution in terms of Section 3 of the STSMA. And do the trustees have the powers to write off arrear levy debt by trustee resolution without a special resolution first being obtained by the BC members?
So Andrew, I know why you're asking the question. The fact of the matter is that there are also different opinions in this regard. We have seen a matter of the High Court in Pietermaritzburg that actually proclaims that levies can't be written off. I venture to say that it is a judgment that we can't support at all, and obviously because of the way that precedents work, it is not necessarily to be followed in other courts. And as such, there are different opinions in that regard. We believe that the trustees have the ability to do so. I mean, I've just mentioned that in terms of the prescribed management rules, they are entitled to write off 10% if there's a payment in advance. So one wonders where that right comes from if there is no such a right at all for trustees to do so, as was stated in that specific judgment. But that is something that will go on appeal eventually. We will also see it in the other jurisdictions. We also know that in terms of accounting practice, and especially in terms of IFRS, once a payment has not been made on time, one has to start impairing that, which means that you will have to make provision for write-off. We also know that the Sectional Title Schemes Management Act says that body corporates can't be audited in terms of any regulatory framework, or shouldn't, or does not require that. But that again is in contravention of the Auditors Professions Act that says no auditor is allowed to audit unless it complies with the framework applied in the country. So we've got some problems in the Sectional Title Schemes Management Act. Myself and Zerlinda has had discussions regarding this with Chief Joubert. It is something that we are addressing and that we are dealing with. So don't know the answer, don't agree with the judgment, and as far as we are concerned, trustees have the right. In terms of Stratafin, we ask for a special resolution of owners in any event to do so. So we put it to a meeting and require that permission. And that's what we're doing. We've also got other mechanisms, which I'm not going to discuss now, but we've got other mechanisms in place also in that regard that we do. And we believe that a scheme must act in a responsible way. And if it is responsible to take a loan and pay back the capital 3 times, and or to take 60% or 70% of your outstanding debtors, one needs to have a look at what is reasonable. Is it better to lose 3 times the capital amount, or is it better to lose 30% or 40% or whatever the situation might be? And the fact of the matter is one can never collect more than the value of a property either. So where levies have exceeded the value of the property, there will be no sale of that property ever until such a time as the body corporate has written off some of the levies, because nobody will pay more for outstanding levies than the value of the property. So yeah, so many aspects that needs to be looked at, not only by us, by the professionals in the industry, but by the legislator as well, and make changes in that regard to make sure that schemes are run in a compliant fashion and in a fashion that is to the benefit of all owners. But thanks, guys. It was wonderful speaking to you again.
Thank you so much for joining us, and yeah, we hope to see you in the next webinar, and you will receive an email either this afternoon or tomorrow morning with all the information that we discussed today. So thank you.
So from Cape Town, cheers.
Yes. Thanks, bye.
Bye, everyone.